afternoon. Welcome and thanks for joining our commercial seminar today. My name is Jenny Ching. I am your 2022 Education Committee Chair. A friendly reminder before we begin, all participants will be muted during the meeting. Please use the chat box for questions and the speaker will answer them during the Q&A session. Today's session will be recorded and will be available at our WSGBAR YouTube channel. Next, Mr. Weiming Lee will introduce our speaker and the topic today. Mr. Lee?
Thank you, Jenny. Let me talk a little bit about Mr. Howard Lee. Are we okay? Mr. Howard Lee is the founding president of the Chinese American Certified Public Accountants Association. He has worked for 4 leading CPA firms in the United States, and currently he works for IFAN US satellite TV station. And he's an IRS certified professional and also deal with the tax ID applications. Mr. Lee immigrated to the United States from Taiwan at a young age of 12, so he probably went to high school and college here. And he has served in California for more than 2 decades. One thing remarkable about Mr. Howard Lee is that he founded the CACPAA, the largest and most inclusive Chinese American CPA organization in Southern California. Now its membership has about 5,000 professionals. Besides accountant, it also consists of some attorneys and some financial people who are investors. Mr. Lee is bilingual, and I assume he speaks Mandarin. He's honored to be a final reviewer for TurboTax, and some of us, we try to prepare our own using TurboTax. And he was a reviewer for TurboTax, and he has seen over 3,000 to 4,000 tax forms, more than average CPA. So he has a lot of experience throughout the years, and he's involved in different lectures and appear in different cables and TV stations. So he has helped a lot of clients preparing income tax returns and try to help with the audits. So if you've got tax issues and things of that sort, Mr. Howard Lee is the person for you to look for. So without further ado, Mr. Howard Lee, the floor is yours.
Thank you so much for the introduction. And let me share my screen. So today's, we'll talk about 4 current tax issues. I'm also a CPA, also a CA, certified acceptance agent, help people to get the ITIN for foreigners. I'm not gonna repeat this part, but if you would like to add or WeChat, you're welcome to add that with your phone. And then if you have additional questions, feel free to ask in the WeChat. FERPA update. First time, well, this is probably the first question when they sell a 4-person sell property, when they have FERPA withholding, about 15% federal, and if it's California, another 3.33. So total of 18.33% of foreign investment property. They ask you, how can I avoid paying FERPA? And the only other way to avoid FERPA is through a withholding certificate. If FERPA withholding exceeds the maximum tax liability realized on the sale of the real property, a seller can appeal to IRS for the lower withholding amount. And this is usually what people will get when they ask their accountant. But is that the real case? Actually, in the IRS website, there are 11 exceptions that you do not have to withhold FERPA, but it does take some planning. I know in the real case, most of the client, when they come to you to sell property, they did not do any tax planning. They sometimes don't even have their ITIN number or tax ID number. So they might not even get their withholding back because if they don't have the ITIN number. But here are some of the cases that IRS accepted that you can avoid or pay less FERPA. Let's go to the exception from FERPA withholding. First, I'll have you guys read this silently, and then I'll get to the important part. Well, first part is easy. If the property is less than $300,000, there's no FERPA withholding. If it's 3,000 to a million, that's 10%. Over a million, that's 15%. Let's go to the second exception. Okay. Let's see. Go to the next one. Okay, you need to fulfill those two following statements. USRPHC is a U.S. real property holding company for those people that need that info. Okay, so we know if it's a public company, then there's no FERPA withholding. But you have to meet these two requirements. Let's go to the fourth exception. So some people, when they purchase a property, they're a foreigner, but they later become a U.S. resident, or they choose to become a U.S. resident, then there's no FERPA withholding. But of course, once they choose to become a U.S. resident, their worldwide income and foreign financial assets are reportable. Yeah, a lot of people doesn't even know there is a qualified substitute option if their attorney or title company is responsible for closing the transaction. Let's go to the sixth exception. Sixth one is the normal one. They apply for a withholding certificate, and they can get withholding less than the required 15%. So some of these things you can talk to your accountant or your the foreigner. They should talk to their accountant and find out what they could plan to reduce from FERPA withholding or exception to meet the exception from FERPA withholding. Okay, if it's acquired by U.S., then there's no FERPA withholding by the government, basically. I'm going through these withholdings fairly quickly. So if you need a copy of the, I guess the PowerPoint, you're welcome to. I'll email to your organization. You're welcome to share this information. You can also look up this information on the IRS website. It has the exact words on the IRS website. Of course, and you also have the recording of this video. Okay, a lot of people ask me this question. If a U.S. real property interest is jointly owned by a spouse, one foreign person and one U.S. person, and U.S. RPI is disposed of, may the spouse, who is a U.S. person, report 100% of the amount realized from the disposition, and a spouse who's a foreign person reports 0% of the amount realized to avoid the withholding required under Internal Revenue Code 1445. Think about that. And we'll go to the next page for the answer. Actually, there's two pages for the answer. Answer number one. So you can't do that. But how do you allocate it? Answer number two. Yeah, we get this question all the time. Husband, wife, but one is a foreign person, the other one is non-resident. So non-resident, that 50% gets the withholding. She feel, oh, he could just give me his 50%, or the non-resident just give me the 50%. So I'm a resident, so I don't have withholding. But the non-resident doesn't have any gift exemption. The gift exemption they have per year is 16,000. Last year is 15,000. So anything after 16,000, there's a gift tax of 18 to 40%, depending on how much it was given to, the other side. So the gift tax might be even higher than the withholding of 15%. So they really need to rethink about that when they do that transfer. Okay, let's take a look at the 1031 exchange update. Boot means any cash other than the property itself. So 1031 exchange, they haven't changed that much, but they don't allow to do 1031 exchange other than real estate properties. So personal property, they cannot do 1031 exchange anymore. And there are 4 types of 1031 exchanges. There's a simultaneous exchange, a delayed exchange, reverse exchange, construction or improvement exchange. So 4 types of 1031 exchange. Let's go through each type. The first one is simultaneous exchange. Go ahead and read that part. So simultaneous exchange, just like what the title says, you change at the same time. So important to have a qualified intermediary because they cannot receive the money. If they receive the money, then they have a large tax bill. So the money got to go to qualified intermediary. But a lot of people ask me, what if the qualified intermediary got my money and flee? well, then you better get a good qualified intermediary. If it's something new, company that does the qualified intermediary, I would just wait a couple years when they, some of the banks can do qualified intermediary. If they have a lot of cash and they're responsible for a lot of cash, you might consider doing with the bank that does qualified intermediary, or get a good reputable company to do a qualified intermediary. Okay, second type of 1031 exchange called delay exchange, which is a normal one that we usually encounter. So again, qualified intermediary has to be used because the seller cannot get their money in hand. They have to delay their tax. And 45 days to identify, 180 days to close. That's the delay exchange. Okay, so if you don't have the exchange property yet, you can select this choice, but just be aware of the 45 days, 180 days limit. It's not 183 days like somebody says. And 180 days is 180 days. It does not go a day after that. Even if the 180th day lands on a vacation or some type of holiday, that's the day you have to close. So it doesn't have any type of extension. So make sure you do it close before the 180 days. The third type is reverse exchange. So you purchase a new property beforehand before you sell your existing property. So that's reverse exchange. So reverse exchange still have the same number of days, which is 45 days. You have another 135 days. If you add those two, it's 180 days. The fourth one is not a lot of people know about, or they do not use it that much, is construction or improvement exchange. Okay, the last sentence, maybe you should read all gains to be, taxed later, because 1031 exchange is not free from tax. It just delays the tax until you sell the last property. Okay, so improvement need to be made within 180 days. So make sure you get a good contractor and make sure it's completed by 180 days. If it's not complete, then you might owe taxes. Okay, let's talk about a third current issue is taxable residents versus non-resident real estate investment tax issues. For non-resident, we know they have FERPA withholding. Um, and we have 11 different ways to either eliminate or reduce FERPA withholding. You can talk to your CPA or your client can talk to their CPA to plan on that if they want to. So some of the client, if they sell a commercial property, 15% is probably a lot of money. Even some really large residential property, like 3 million and above, the withholding is significant. And 4 ways to avoid capital gains on rental property. There's capital gains tax for both the resident and non-resident. And how do we avoid or reduce that part? Let's take a look. Usually the generic answer is you either get taxed for short term, which is within a year, or a long-term capital gains rate at a lower rate. Okay, the first one, purchase property using your retirement account. Well, this only works if they have enough money in their IRA or Roth IRA 401k account to make a purchase of the property. But the tax advantage is there if they want to do that. Well, let's take a look at the second way to reduce or eliminate capital gain. So taxable resident, each is 250,000 capital gains for husband and wife. I see some people, they give like 1/3 or 1/4 of their primary resident interest to their kids, and then add their kids' title to property. And the kids are over 18, they get another 250,000 capital gain exemption if they live there 2 out of 5 years. So that's one way to increase their capital gain exemption, but they have to meet the 2 out of 5 years, and then they have to use up part of their gift exemption, but they can save significantly. But the primary issue, the resident has to be, the capital have to be above 500,000 to be reasonable. So it's a really expensive property. Some people they add that extra 250,000 capital gain exemption by adding their kids to the title, but that takes some planning too. Can't do it at the end because it counts a day when the name actually transferred on the title itself, and they have to live there for 2 out of 5 years. Okay, let's use the 200,000 rental property that we discussed. So we're just using whole numbers. So 200,000 property, after 10 years, it became 300,000. So there's 100,000 capital gain. And we just assume it's meet the middle portion, which is 15%. So the tax they have to pay is 15,000. That's not counting the depreciation recapture and other costs in there. So the key point is, in order for this to work, they cannot sell another property for at least 2 years. So, and they have to live there 2 out of 5 years in order for this to work. Okay, if they use the property as both rental and personal residence, they have to calculate qualified versus non-qualified use of the property. So that could reduce their capital gains. So their capital gain exemption is 250,000. That portion could be reduced because they have, used the property partially for rental. So that actually they have to count the number of days they use for personal and number of days for rental, and they can calculate that portion. The third way is use tax harvesting. So if they made a gain on one property, if they loss on another property, they can offset each other. And if they have they made a gain on the property they sold, but they had a loss on their stocks, they could do that, offset each other. And I even see some people, they made a loss on their antique, they sell it, and they made a loss and was able to reduce, offset some of their capital gains on the property. So these are some of the ways to use tax harvesting. Fourth, of course, use the 1031 exchange, tax deferred. Okay, and we discussed the 1031 exchange prior as well. Okay, let's talk about the last issue, current issues, virtual currency tax issue. First, what is virtual currency? Virtual currency is, the keyword is virtual. It's not like actual currency, US dollar or Chinese RMB. Actually, you can see and feel. Virtual currency is just digital. So there's two major type of virtual currency. There's a digital currency, and there's the cryptocurrency. Crypto is when you have to encode it. So you have to have the password to decrypt the currency. And how many type of virtual currency are there? There's over 5,000 different type of virtual currencies, and more than 4,000 is actually in the market today. And it transacts about $2 trillion in virtual currency last year, believe it or not. So a lot of virtual currency trading. What is ICO, initial coin offering? Literally, if you have some computer knowledge or you have somebody that's technical, they can actually create a pattern for you to have your own currency. Initial coin offering, but there's an issue. It can, most of the ICO, they involve fraud. They have to pump and dump. When they advertise this is the next big thing, you're going to make a lot of money in the future. But once you invest in it, they would dump the ICO, and then you have a significant loss. So a lot of advertisement on the ICO has been banned by the SEC. And also, it was ICO, a new type of virtual currency. There's high risk because lack of trust by financial industry. Most people don't use it. Bitcoin is the most popular currency in the virtual currency market. It actually owns about 42% of the entire virtual currency market. So Bitcoin is a lot of people are using it. What type of virtual currency transactions are taxable? When you sell virtual currency for US dollars, that's taxable. When you exchange one type of virtual currency for another, for example, Bitcoin for some other type of virtual currency, that's taxable. When you receive virtual currency for services, for example, people pay my service for virtual currency, that's actually taxable to me. If I purchase computer to mine, I do mining of virtual currency, that's also taxable. A lot of people didn't know that. Those are actually income. Which type of virtual currency transaction are not taxable? When you buy virtual currency with US dollar, when you're just buying it, just like when you buy stock, it's not taxable. When you sending virtual currency to different wallet with the same owner, for example, I have two digital wallets, and I transfer from my left wallet to my right wallet. For the same owner, then that transaction is not taxable. Virtual currency tax reporting. Virtual currency are not treated as real currency like US dollar, but more like property or stocks. Capital gain or loss are treated like stock. They want to see if there's capital gains on it when you purchase the market price and when you sell it the market price. Virtual currency are subject to information reporting on the tax return. 2 years ago, that's when they first asked, do you have any virtual currency transaction? If the answer is yes, you actually have to make a check mark on it on your tax return. I was starting to track those transactions. Some people, they does the virtual currency mining or Bitcoin mining, they never report it, and they when they get reported, they have a lot of income. So for people that does virtual currency, they have to be aware of that. And receipt of virtual currency is income at the fair market value at day of receipt. So if somebody pay me today with Bitcoin, then I have to record it as the Bitcoin, that's exchanged today's rate to report that as my income. VC tax. Let's go to the next page. What can you do with VC? You can buy goods and service with virtual currency. You can invest in virtual currencies. You can actually do payroll virtual currency. You can pay people with virtual currencies, and you can pay bonuses with virtual currency. Online gaming and sports, a lot of them, they use virtual currency. Online gambling, dark net market, and also money laundering. Unfortunately, they use a lot of virtual currency as well. How do you get virtual currency? You can buy it, you can mine it, you can work or trade for it. You can mine by solving complex mathematical problem, solve a certain problem, they get mining reward. Miner also earn fees by posting transactions to the blockchain. The next question is, what is blockchain? Because if you deal with the virtual currency, you got to know what blockchain is. A blockchain is a distributed public ledger that compared to a traditional ledger where a transaction is a line on the blockchain. And in a ledger, a block is actually a page of all the transactions. And the entire blockchain is the continuous accounting ledger. So it's like a accounting ledger of all the transactions for this specific virtual currency. So that's a blockchain. It has all the transaction, actually when it was transacted. Sometimes they don't put in their real name, but they will have exactly when it was transacted and how much was transacted. A typical cycle virtual currency is a taxpayer buys virtual currency using US dollar, and that when they purchase is recorded as their basis, the fair market value as their basis. And the fair market value of virtual currency fluctuates over time. It doesn't have inflation, but it fluctuates with the market. Taxpayers use virtual currency to pay for goods, and that's when they have capital gains or loss. Because when they buy the virtual currency or trade the virtual currency, that's at that time the fair market value might be low. When they actually spend it, the virtual currency value might be high. That capital gain need to be reported. And the next part is taxpayer calculate the capital gain by the fair market value of goods purchased minus the cost basis, how much they got it for. And the taxpayer report a capital gain or loss to the IRS. So that's like the typical cycle of a virtual currency. Where can you use virtual currency? Bitcoin is accepted by 150,000 businesses, including PayPal, Dell Computers, Amazon, Tesla, Virgin Galactic, Overstock, Gap, Macy, Best Buy, Hilton, Old Navy, CVS, Home Depot, Starbucks, Microsoft, and even Walmart. You can actually use Bitcoin to get Walmart gift certificate and use the gift certificate at Walmart. So it can be used in a lot of common day places. And why do people use virtual currency? Mainly a couple of reasons. Is very fast. It's globally mobile. You can take maybe a USB drive and can transfer your virtual currency. A lot of people in China, although it's illegal to trade in Bitcoin in China, they do it in the black market, and they can get the money, and then they take the USB drive and come to US and find a virtual currency that could transfer that into US dollars. Because in China, if you were to transfer money through the banking system or the SWIFT system, they have a limit of 50,000 per person, or 50,000 per person or per passport. So with virtual currency, they can literally transfer millions of dollars with a USB drive. It is inexpensive. It is secure. If you know about computers, it's fairly secure. No inflation, but market volatility. But volatility could sometimes be greater than inflation. And some people, they use it because it's anonymous. They don't have to record their real name. But IRS is cracking down on that portion. And BTC, Bitcoin market fluctuations. Just give you an example. In 2010, May 22nd, Laszlo bought 2 pizza for 10,000 Bitcoins. If owner were to hold that Bitcoin in April 2021, he would have over $600 million. So imagine he spent $600 million future money, bought those 2 pizza. Nobody knows back in 2010 that Bitcoin's going to go so high. But December 7, 2018, the price briefly dropped below 3,300. It's a 76% drop from the previous year. At April 10, 2021, Bitcoin is back to above 60,000 as Coinbase get ready to go public in the stock market. May 19, 2021, Bitcoin price dropped almost 50% to 30,000 because Tesla sold his Bitcoin withholding. And Chinese government also supported the cryptocurrency crackdown. So they make it illegal to trade Bitcoin in China. So that affected price as well. Back in November 8, 2021, it went to its about 5 months ago. It's traded at 67,582, and Bitcoin today is 38,651. So market fluctuation is significant. And that's why I asked a couple realtors, say, do you accept virtual currency or Bitcoin to purchase property? Most of the realtors, they do not, because the fluctuation just too high. If it goes up, sure, everybody's happy. But if it goes, because in the escrow, it closed between 30 to 45 days. The market fluctuation could go wild in that 30 days. You could literally lose all your commissions within 30 days if you use Bitcoin. So if it goes up, then everybody's happy, but it goes down, oh my goodness. That's why most, or I don't know, I haven't done a research yet, but a lot of escrow, they do not accept Bitcoin to trade real estate. Okay, and at the end, we have 15 minutes of question and answer session. And here's also my contact information. You're welcome to jot that down, email me later, or scan that for WeChat. And if you use other platform other than WeChat, we can use other platform as well. So that's where we're at right now.
Thank you, Howard. Mr. Lee here. I'm going to talk to the audience. Do any one of you have any question that you can raise to Mr. Howard Lee? I'll wait for a couple of minutes. Howard, I have got some question for you.
Okay.
Talk about 1031, and then there was something called reverse exchange. Basically, as I understand it, is that I identify a property first. I want to buy it, and then if I got it, then I'll sell one of my property. Is that how it works?
Yes, it's basically you got the new property first before you sell your existing property.
Okay, let me pursue from the line of question that I have in mind. So let's say I buy the property and they want 100% cash and I don't have cash. So I'm going to sell my whatever property. Let's say I buy for $1 million and now sell one of my property. Hopefully it'll sell for $1 million. Let's say it doesn't sell for $1 million. Let's say it sells for 800 or whatever. It drag on, or I'll wait till the market gets up to my price. What should I do in that circumstances? Would I lose the sale, or would I lose the deal? Or I was just thinking, I'm just playing with the game.
Well, you still have to meet the 45 and 180 days rule for the IRS. You have to identify and you have to close.
Close, what happened?
If you don't close, then you have to pay the capital gains.
But I haven't sold my property yet.
Right.
Let's say
you're waiting for the property to go up in price, but if you don't, even if it reverse 1031 exchange, you still have to meet the 180-day rule. If you go above that date, then they have to charge you capital. You have to pay. Your client have to pay the capital gains tax for that.
Oh, I see. You mean the person I'm buying the property from, he has to pay the capital gain in case the sales fell out?
You buy it. That's correct.
Ah, so he'll get really mad at me if I cannot take over his property, because otherwise he'll end up paying his capital gain.
Yeah, he'll be mad. He might tell his friend that to be mad at you too.
Okay, got it. No, I just want to be sure, because sometimes that is, how should I say it? That's a safer route.
I totally understand, but the 45 and the 180 day is a set rule that they don't allow even one extra day for that to work.
Ah, okay, all right. So thanks for clarifying that. Okay, so I have to be considerate and courteous to the sellers. Audience, any question? Okay, let me raise another question. There's a $250,000 exemption, and you mentioned that if you have lived there for 2 of the last 5 years, let's say I and my wife live in property number 1, I finished that, and then can I move to property number 2, convert that rental into a primary residence, and just keep on doing it, moving from house to house, just to avoid that capital gain? Is that possible, or is just one lifetime exemption?
No, it's every 2 years. So if you live there for 2 years, you get another 250,000 exemption.
Then I move on to another house and live there for 2 years. I can just, let's say if I got 10 property, I just keep on doing this, right? Hopping from house to house, carrying my luggage.
Yeah, that's true. Every 2 years, you get a 250,000 exemption in that. But just if it's a rental before, you have to take a look at the non-qualified use portion. That might reduce the 250,000 capital gain.
I thought if there's a proportion, let's say if it's a rental, I'm telling a tenant I'm moving in next month, and I live there for 2 years. So will IRS look at out of the last 5 years, you only live it 2 years. So is there a ratio involved in the percentage of tax that might be exempt for my short-term resident, knowing that Mr. Lee is on a scam?
It is. There's a ratio involved. Actually, they use number of days. They on a tax return, it has a worksheet. It calculates the number of days that you use for rental and number of days you use for primary residence, and that calculates that ratio. And that ratio will reduce your 250,000 capital.
Okay. So that's a factor involved in figuring out the amount of tax that might be exempt based on my duration of the residence.
That's correct. Yes.
Okay. No more questions. I'll throw one more out and that's it. Okay. I know your time is valuable. I'll throw more. Virtual currency.
Yes.
This is totally new to me. I know a little bit about Bitcoin and lithium. I have never seen what you mentioned about virtual currency. What would you consider as a virtual currency? You mentioned about stocks or properties. Are they in some denomination that I and the buyer or whoever that I'm selling things to understand? Is it like a Japanese yen, or is it paper, or is it we agree on an X dollar this is, and then I will create something on a computer and you understand, I would say, okay, sell it to me, I'll give you X. How does that work?
Actually, it's like a digital wallet. It's actually kind of like a bank account, a digital wallet, and you have a special code. For Bitcoin, their digital wallet is very detailed. When
yes,
you purchase
the regular other virtual currency.
Right. And then every time you transact, when you use it, they calculate the capital gains on that. So actually, we have clients that have they purchase Bitcoin, they use it in either Walmart or Starbucks, and they have to calculate the gain each on that. And then ours is tracking that. In the future, ours will require these virtual currency platform to give taxpayer a 1099 showing all the transaction, just like stocks. All the capital gains, either short term or long term. So that's what ours is trying to do. But right now, it's just kind of new. People are not used to it, but a lot of people are getting used to it. I think the people that I worry the most is the people that purchase computer and mine these Bitcoins, and they don't know that when they mine, and I have a client, they just buy a couple computer. Each computer will make them like $100 a day just to mine a very little portion. But that's considered income in the IRS point of view, and a lot of people, they're not reporting these mining income, and then when they finally transact that, they will have a significant tax, and because they mine over all these years, these tax will be calculated for each year, and there will be additional penalty and interest for these mining income or virtual currency mining income. That I think.
But Howard, these people are unaware of this, right?
Yeah, a lot of people, they say, "Oh, I just nobody knows what's going on." But actually, the blockchain has every single transaction, listed on the blockchain, and IRS is getting more and more familiar with how that works, and some of the way that they're trading without letting IRS know their capital gains.
Okay, I'm curious on this. One more question on the virtual currency. Let's say if I have a transaction with another person, he and I have to be on the same virtual currency platform before we can create a transaction. Am I correct? So we understand what type of items are being exchanged, dollar for dollar or yen for yen or rubles for ruble, so we can agree upon what the price is. Is that true?
Yeah, if you have to trade the same type of currency, they have to use the same platform. But
Okay.
right now, there's more and more platforms that are mixing different type of virtual currencies. You can actually go online and see which platforms support which currencies. And then if the same platform supported two different type of currency, you can actually use that platform to trade if it support two different type of currencies.
Thank you, Howard. You gave me a better understanding what it is. I don't have enough money to do that yet, so but at least I gained some knowledge from this, and I enjoy it. Do you have anything to add? Does the audience have anything to add? Okay, so thanks for your time, Howard. I'll transfer it back to our chairperson, Ms. Jenny Ching.
Sure, you're welcome.
Thank you.
Thank you, Mr. Wei-Ming Lee, and thank you, Mr. Howard Lee, for your presentation. If anybody has any additional questions, please feel free to reach out to Mr. Howard Lee directly. And also, please check out for other education classes on our website. We have a few more sessions in March. March 15, we have typical title clearance problems with Nancy Chen. And on March 22nd, we have tax update. So please register on our website. Thank you, everyone, and have a good day. Bye.
Bye-bye, Howard.
Thank you so much for inviting me.